we will talk about budgeting. So this gives you your learning objectives for the chapter. Budgets do play a very important role in businesses. Normally they do an annual budget, but it helps them determine their cash flow, if they need to borrow money, if they're going to be making money, you know, if they have changes in their sales. So we'll talk about all those different things. But it normally is an annual thing that most large companies do. So it'll establish goals, it'll execute plans to achieve those goals, and then normally companies will then compare their actual results to their budget so they can see how they're doing, maybe make changes as the year goes on. So again, it's definitely a part of their planning process, and it can be broken down into like different departments. So maybe like geographic areas or even just departments within the company, depends on, again, what type of business it is. And then companies always then look at, or they should always look at, the actual performance compared to their budgeted. So again, they can make changes, or they can see where they're doing good or doing bad as the year is going on. So it's, you know, it's planning, directing, controlling, and then that controlling provides feedback to maybe, you know, make the planning better, all that kind of stuff. So what can impact our budgets is that if we want to set goals that are actually realistic. If we set them too hard or too, you know, they're saying too tight, but so that they're going to be out of reach, then nobody's really going to, you know, accept this budgeting process or ingrain it into their culture. If it's too loosey-goosey, then you know, that they know they're going to achieve it, again, then there's no motivation. Like, no one's even trying because we know we're going to make those goals. And then it definitely should not set conflict between the company and the employees. So sometimes what could happen is, say we want, you know, like we want something bigger picture to happen in the company, but then we're giving the employees a different budget than what we really want to happen. So then like we're working against each other. So the employees want to live up to their budget, maybe to get their bonuses or whatever, but then the company really has a bigger picture. And if those things are ever conflicting, which sometimes happens, then that causes problems. So again, here just shows you that. So again, if we make them unrealistic, then again, we're not going to motivate our employees and our managers to actually try to achieve those goals. If they're too loosey-goosey, then again, no one, you know, there's too much cushion. No one really has to try extra hard to get them if they're too easy. And then here is a good example of that goal conflict. So assume the sales department manager is given an increased sales goal. So as a result, she accepts customers who are poor credit risks because they're going to get the sales, right? But then they may not actually collect the cash. So that overall isn't good for the company. So we don't want to motivate those people to just go out and get any sale they can. We still want to get a quality sale that the person actually pays us. So again, budgeting can be done quarterly, annually, monthly, weekly. It could be continuously budgeted. I feel like most common what companies do is a 12-month budget, but sometimes those could be adjusted if something really changes in the business. So the annual budget, again, normally it's done, like you say, like October-ish in the fall months for the upcoming year. And then like in places I've worked, we actually had a guy who was just like the budget director. He was in charge of the budget, but the controller and the CFO definitely kind of pushed some of the scenarios down to him to create. So it was definitely a group process. You could have zero-based budgeting where managers will estimate the sales, and they'll start maybe with last year's budget and then revise it for what they expect to coming up in the upcoming year. A static budget shows results of, again, whether it's each geographic area or each department. And it's not necessarily adjusted for any changes in your activity levels. So, and I guess like at a college or a higher education institution, that's kind of probably how our budgets are set up, where it's a specific amount and it's not changed. So even if, like student enrollment goes up, we're kind of stuck with that budget. So that's not necessarily a great way to budget. So here they give us an example: direct labor, power, salaries, these department costs. And again, those would be kind of set for the year. Our flexible budgets are more set to what happens in our sales activities or our production activities. So we identify relevant activity levels. So maybe it's going to be units produced or sold. Maybe it's machine hours, direct labor hours. Think back to our different activity bases that we've talked about. And then we identify our fixed and variable costs associated, and then we prepare that budget for each level of activity. So here's an example. So if I produce 8,000 units versus 10,000 units, you can see my budget changes. Now, these variable costs obviously go up with each unit. The fixed costs should not, as long as we're within that relevant range. So we're not going to add another supervisor because we make 2,000 more units. But a flexible budget, again, is more useful just because it does factor in those changes in your production or your sales. It could be used in service businesses. Again, so they give us the example of like a hospital. So how many rooms have, or how many patients, how many rooms are filled, those types of things. So we've got a static budget over here. We're at strictly 8,000 units. So again, if we end up producing more, we're over budget. Then we have the flexible budget at each different level of activity and then we could compare that to our actual results at that unit, at that level of activity. Most companies are definitely using computerized budgeting systems. There's all types of different applications that and software programs that can be used that make it easy to just push through changes and populate those budgets without a lot of work. A master budget is a set of financial budgets over a period of time. So you could have a budgeted income statement, and then you can have a budgeted balance sheet. So here again shows you those changes in our budgeted income then funnel into our budgeted balance sheet. So again, if we needed to buy a new piece of equipment or our sales go up, our accounts receivable are going to go up. So those things help to prepare the next statement. So here we have our sales budget, which then pushes through to our production budget. Again, it's going to determine how much direct materials we need, direct labor, overhead. That'll give us to our cost of goods sold, to our income statement, and then that income statement goes into the balance sheet. So a sales budget, we normally have to start with estimating what our sales are going to be. So normally we start with what they currently are and then say, okay, well, what do we think is going to happen? Maybe we're going to spend more on advertising, so sales go up. Maybe we're going to lower our prices, so sales go up. Maybe we are looking at the economy and we know that, hey, these things are going to happen, so our sales could go up or down with those. So we always start with what it is, and then we push through some of these changes. So like I said, you can break it down into your geographic area and your type of product that you're selling. So then you've got, okay, these are my geographic areas that they're selling this much, these two different products. So my total sales budget is that. Then your production budget, you have to go through to look at, okay, well, how many do I think I'm going to sell then? Because obviously if I know what I'm going to sell, I got to produce those. So I'll have my units to be sold, what I want to have in my ending inventory, what I currently have now, and that's going to give me what I need to produce. So then we know, okay, we need to produce so many wallets and so many handbags. Again, we have this current inventory, we expect to have this, and then we estimated what those sales are going to be from that first budget. So then now we know how many we need to produce. And then once we know how many we need to produce, that's going to create our direct materials budget because we know what goes into each purse or handbag. So then we're going to have to figure out, okay, these are our materials required. Again, we have the ending inventory and the beginning inventory factored into this as well. So then how much do we need to purchase, and then times whatever price that is. So then here we've calculated our direct materials that we need to purchase, again, based on what we need to produce, based on what we estimate those sales to be. And then here again shows it mapped out by the type of direct materials that we're purchasing, again, to meet the wallet and the handbag and the desired ending inventory, and we can multiply all of those out. Direct labor is going to follow right along. How many direct labor hours are required to produce that product? Again, that goes back to our estimated sales. So we've got cutting and sewing for both the wallet and the handbag. We've got hourly rates associated with those. So then we're going to take those and say this is how many we need to produce times our hours, times our hourly rate gives us our total. And then we break that down for both of the departments. And then our factory overhead, again, that is going to depend on how that is set up. But we have our total budget for the factory overhead, our wages, our salaries, electric, depreciation, indirect materials, maintenance, all that type of stuff. It would, again, depending on what area and what type of business we're looking at. Then our cost of goods sold goes into what direct materials, what direct labor, and the overhead. So all those budgets combine to get to what our cost of goods sold is. Again, we have to factor in those desired ending inventories. So then we've got our direct materials coming in, our work in process, and our finished goods from our beginning inventory, and then our ending inventory. And then we know what we want to then sell out. So here we've got our beginning inventory up above, and then we have our direct materials purchased coming in from our direct material purchase budget. Then we have our direct labor coming in from our direct labor budget, and then our factory overhead. So then we total all those up for our manufacturing costs. We factor in what is left in our ending inventory, and then that's going to be our cost of goods manufactured. And then we factor in what's left in our finished goods ending inventory, and then that's going to be our cost of goods sold. Then our selling and administrative budgets. Again, the sales budget is another good place to start there. So we've got our selling expenses, our sales salaries, our advertising expense, travel expense, then our administrative expenses. So our office salaries, our office rent, our office supplies. And then all those are going to come together for our budgeted income statement. So we'd have our revenues coming from our sales budget, our cost of goods sold coming from our cost of goods sold budget, selling administrative expenses coming in from that selling administrative expense budget, and then we will calculate our interest revenue and expenses, and then that will bring us to our net income. Now, our cash budget is another important budget because it helps the company realize if they're going to have a short amount of cash that they need to go out and get financed in order to maintain their current sales budget. So the first thing we do is we estimate our cash receipts. In order to do that, we need to know how the company collects their cash payments. So we start with our budgeted sales, and then we look at it to say, okay, 40% of the prior month's sales are on account, and they'll be paid in that month, or they'll be paid in the month of January, but they're from the prior month. 60% will be paid in the current month that we're in. So then we've got to tier those out. So if our January sales are 1,800,000, 40% of those are going to be collected in February, and then 60% of February's will be collected in February. So we're always like kind of tiering those between months, because again, you don't get them all in the month of the sale. So then we're, excuse me, mapping those out by month so we can see our total cash receipts for the month. Then our estimated cash payments. Some of those will be in the month as they're incurred. Some of them will go out a little bit. So we've got our manufacturing costs. We're going to add back our depreciation because depreciation is not a cash payment. And then it tells us that our accounts payable, how we pay our bills, 25% will be paid in the upcoming month and 75% will be paid in the current month. So again, they show that mapped out. Like if we're focused on February, 75% of February's costs will be paid in February. 25% of the prior months, January's, will also be paid in February. So here again, they're showing it mapped out by month so we can see those costs, and again, not factoring in depreciation because depreciation is not a cash expense. So then our actual cash budget is our estimated cash receipts less our estimated cash payments gives us a cash increase or decrease. Then we add our beginning balance, and that will give us our balance at the end of the month. And then we normally have a minimum, like we say we want to always have 50,000 in the account or something like that. So then we know if we have extra or if we don't. So here they give us an example of our beginning cash balance, taxes that were paid, interest that was paid. So some of these are things that don't happen every month, but we do have to factor them into our cash budget. So then our selling administrative expenses are paid monthly. So those are a common one that goes across all 3 months. So then we've got our cash receipts at the top, which comes in from our schedule of collection. How are we collecting on those cash? Then how are we paying for these manufacturing costs? Again, those were tiered across a couple months. Then our monthly selling administrative that comes out every month. And then those unique costs that are only certain months, again, because they are quarterly payments or we purchased an asset. Then as we look through that, we can go down to say, okay, well, as we're looking at it, February, we're going to be a little bit short of cash. So February might be a month that we want to look at how can we transfer money in from maybe like a short-term savings account or a line of credit or something like that. The capital expenditure budget goes right along with that operating budget to say, are we going to need to buy new equipment? Again, are there things that are reaching the end of their service lives, or do we want to expand because we are now meeting increased sales? But those are all things we have to plan for, partly because we have to know if we've got the money to do it or if we need to borrow from the bank. So here again, we broke it out here by 5 years so we can kind of see how that spending is going. And then our budgeted balance sheet is going to come in after we've budgeted all these other things. So, so like our income statement helps to create what is going to be in that balance sheet from inventory standpoint and accounts receivable standpoint. The capital budget that we just had here determines how that's going to be with our long-term assets and if we need to borrow the money to get those. So that kind of feeds in to create that balanced or that budgeted balance sheet.